Welcome to the Lance Roberts Show podcast right here at realinvestmentadvice.com. And on our phone today, we're doing a phone interview with Bethany McLean. She's the New York Times bestselling author of The Smartest Guys in the Room, The Amazing Rise and Fall of Enron, All the Devils Are Here, The Hidden History of the Financial Crisis, and so many more. And of course, coming up here in just a few weeks, Saudi America, the truth about fracking and how it's changing the world. Bethany, you actually talked to a couple of partners of mine recently about what's going on in the shale industry. So I'm really interested to read your book when it comes out because, again, being here in Texas and in Houston, shale fracking and the oil industry is very near and dear to our hearts. But, specifically about Enron, I was here in Houston in 1999, 2000, 2001, right in the midst. In fact, I was doing a radio show back then. We were right in the midst of watching the collapse of Enron real time. What happened to the thousands and thousands of employees here in Houston that had 401k plans and pensions, et cetera, with Enron. And it's interesting here, December 2nd is the 17th anniversary of the fall of Enron. And of course, today with us is Bethany McLean to talk about that. So Bethany, you've done a lot of research and reading and writing about Enron and what happened. And of course, those were the preceding seeds, I guess we could say, that actually led up and actually fueled part and parcel of the financial crisis, 7 years later. What was your biggest takeaway from when you were researching and studying Enron? What really set you back on your heels and go, wow, I had no idea that was really going on?
I think the complicity, and I use that word not in a legal sense, but rather in an ethical sense, of all of Enron's enablers, from the bankers who continued to give them loans, even understanding that they were misrepresenting what the transactions were on their financial statements, to the lawyers and accountants who signed off on transactions that misrepresented economic reality, to the board of directors, which also gave its permission to some of Enron's most egregious structures and then never really checked to make sure that what was happening was as had been promised to them. And so you can't think of Enron as a couple of guys down in Houston, Texas, doing bad things. You have to think of it as enabled by a system that was very much complicit in this, and that was a total shock to me.
Well, and Bethany, here it is, and we kind of look at the evolution of the markets, really starting back during the dot-com era. We can go back to that point, talk about all the companies that came public because they had a .com stuck to their name. They came public. They had no financial wherewithal whatsoever to be a viable company, yet we were in a rush to take them public because there was a public demand to want to buy those companies. And of course, investors lost billions of dollars during the .com crash. We saw the same thing occur in 2008, leading up to the financial crisis. Again, we have a system that seems to promote or to overlook, poor financial structures just in the process of trying to deliver, a product to an investing environment, regardless of the risk to the individual investor.
I think that is a great point, and I think the overall message to investors is buyer beware, right? That's it's ever been. But I think if you expect that because Wall Street is taking a company public, or Wall Street is underwriting a subprime mortgage, or Wall Street is lending money to a particular company, well, then it must be that Wall Street has done due diligence on it, and this must make sense as an investment. Or even that a Wall Street analyst is telling people to buy the stock. You think this means something. Right. In truth, it means absolutely nothing. It means that Wall Street is making fees and has figured out a way to enrich themselves, and it means nothing as to the long-term viability of whatever the thing might be, and it means nothing about the ultimate damage it might do to our economy. It means purely and simply that there's short-term financial gain for Wall Street and whatever they're doing, and that's it.
Well, and it's interesting because, in your new book that's coming up, talking about the shale fracking industry, we've seen, and again, this has been something that's actually been enabled by the Federal Reserve as well, because, if you go back and look at the rebound in oil drilling, particularly in the shale fields in particular, it really coincided with this whole idea of ultra easy accommodative policy. Banks with ultra low interest rates, banks were willing to loan money out to really less than viable, drilling companies for fields that have very short life expectancies, et cetera. And we've now got a tremendous amount of subprime debt or sub-quality debt. I shouldn't say subprime, but it's high yield debt on less than quality companies that has been given out to fuel this drilling, particularly in these shale fields. And so again, here we are, to your point, 2 decades later, we're still doing the same thing and expecting a different outcome.
Yeah, I think that's a really fair point, and I think it's really interesting that there's this very direct link between the financial crisis and the shale revolution, as you point out, which is not obvious at all until you think about it. But because drilling companies are so heavily dependent on debt and cheap debt because they're not profitable, if it hadn't been for the Federal Reserve's actions in slashing interest rates after the financial crisis to boost the economy, it's unclear whether we would even have had a shale revolution, certainly not of the magnitude that we did. And there is skepticism about the financial viability of many of these companies. The only certainty in all of this, once again, is that Wall Street has made a lot of money by raising capital for them, and in the case of private equity firms, investing and flipping.
So here's the interesting thing. And Bethany, I mean, your research and your work dovetails exactly with what I've been talking about really since 1999. I've been writing articles and writing reports and studies on these different issues. And, I'm mostly written off as just by being, bearish all the time. But, what my focus has always been at Real Investment Advice was to point out the risk to investors, right? Because as individuals, if we lose 30 or 40% of our money, getting it back to even is fine, but that's not the same as making money. Spending years getting back to even, trying to recover losses. And yet we have these financial companies on television. UBS, one of my favorite lines in their commercials was, UBS, it's you and us. We're in this together. We're going to help you get on the beach and be retired. But to your point, everything that we look at, Wall Street is really a predator on, individual Americans, hardworking Americans. Wall Street takes advantage of them.
Well, I guess it depends on what your view of the contract between Wall Street, and I obviously don't mean contract in a legal sense. I mean the unwritten contract between Wall Street and Americans is. If you think it's that Wall Street promises to do things that are in people's best interest, and Wall Street means that if it sells a product, that product should be viable and a good product for the investor, then then you're totally right. But if again I come back to this idea of buyer beware, if you think that investors have a responsibility to do their own due diligence and to realize that Wall Street is not operating in their interest, and in fact, the harder Wall Street is pushing something, the less likely it is to be in somebody's interest, then maybe you say, okay, that's just the deal, and it's a more skeptical, if not cynical approach, but I think the right one.
Yeah, I absolutely agree with you. The problem is that, unfortunately, you take a look at statistics, the average American doesn't have $500 in the bank. The average 401k balance is $26,000. We don't teach in school, we don't teach in college to any great degree, any type of financial education. So when we talk about buyer beware, we're assuming the buyer is educated enough in the first place to do the due diligence themselves, right? To research the product, to understand what the risks are, et cetera. But we don't arm them with that type of information. But hold on, because we're going to be right back with more of Bethany McLean right after this on the Lance Roberts Show podcast right here at realinvestmentadvice.com.
Baby.